Sandisk's Investor Day promised a much larger AI storage opportunity, stronger customer visibility, and unusually ambitious long-term margins. Yet by August 24th, SNDK had fallen 6.47% in one session and closed below its Investor Day level. The central question is whether this reversal exposed a broken AI thesis or simply reminded investors that NAND remains volatile even when the long-term opportunity looks compelling. This is educational research, not financial advice. Please verify all data independently. Sandisk sells NAND-based storage products across 3 reported markets. Edge remained the largest business in fiscal 2026 at $12.16 billion, covering products for devices and embedded applications. Data center revenue reached $5.15 billion as enterprise SSD demand accelerated, while consumer generated $2.94 billion through removable cards, USB products, and other retail storage. Pricing, shipment volume, product mix, and technology transitions influence every segment. AI systems require storage for training data, model files, retrieval databases, generated content, and inference workloads. Sandisk estimates enterprise flash demand could reach 1.2 zettabytes by 2030. Higher density QLC can improve storage economics, while high bandwidth flash aims to place much more persistent capacity near processors. However, HBF is still an emerging architecture. Product qualification, packaging, software support, and customer deployments must precede meaningful commercial revenue. Sandisk's 3-year record shows why investors should distinguish structural AI demand from the memory cycle. The flash business lost money in fiscal 2024 and fiscal 2025 before revenue nearly tripled to $20.25 billion in fiscal 2026. GAAP net income then reached $11.43 billion, and operating cash flow rose to $11.67 billion. The earlier periods are carve-out results prepared as though Sandisk operated independently before its 2025 separation. Fiscal 2026 was an exceptional year. Revenue increased 175% to $20.25 billion. GAAP net income reached $11.43 billion, and operating cash flow reached $11.67 billion. GAAP gross margin expanded to 71.5% as NAND pricing and higher value customers supported profitability. These figures provide real evidence behind the bullish thesis, but one unusually strong year does not prove that peak cycle economics will persist. Data center became Sandisk's fastest growing market in fiscal 2026. Revenue rose 437% to $5.15 billion and represented roughly 1/4 of company revenue, up from about 13% 1 year earlier. This mix shift ties Sandisk more directly to AI infrastructure spending through enterprise SSDs and data-intensive workloads. It also raises the importance of sustained cloud demand, customer qualifications, and disciplined NAND supply. By Investor Day, Sandisk had signed new business model agreements with 8 customers. Management said these arrangements represented about half of planned fiscal 2027 bits, and roughly 2/3 of fiscal 2028 bits. That coverage may improve volume visibility and production planning compared with older NAND cycles. Still, investors do not have a complete view of pricing mechanisms, customer concentration, guarantees, or expected margins, so contractual visibility does not eliminate execution risk. Management's fiscal 2028 through fiscal 2030 framework targets mid to high teens revenue growth, approximately 80% non-GAAP gross margin, approximately 75% non-GAAP operating margin, and about a 50% adjusted free cash flow margin. Operating expenses are expected near 5% of revenue. These are forward-looking non-GAAP ambitions rather than reported results. Achieving them requires favorable pricing, disciplined supply, successful technology transitions, and durable customer demand. At the August 24th close of $1,492.82, Sandisk traded near 20.2 times fiscal 2026 GAAP earnings and about 10.8 times trailing revenue. Its market value was roughly $218.6 billion. The remaining buyback authorization equaled about 7% of that value. But authorization does not guarantee purchases. The valuation therefore depends heavily on whether fiscal 2026 earnings are sustainable or represent unusually favorable cycle conditions. A publicly aggregated analyst snapshot showed 20 buy ratings, 3 holds, and 1 sell through the August 24th close. Against a market price of $1,492.82, published targets ranged from $1,000 to $3,600. That $2,600 spread is more informative than a simple average because it highlights deep disagreement about NAND cycle durability, AI storage growth, and the appropriate valuation multiple. Ratings and targets can change and are not company guidance. The bull case starts with reported evidence. Data center revenue grew 437%, operating cash flow reached $11.67 billion, and customer agreements cover a meaningful portion of planned fiscal 2028 bits. The bear case starts with the same history. Sandisk lost money in the prior 2 fiscal years, HBF has not yet produced proven commercial revenue, and the stock still trades near 10.8 times trailing sales. NAND pricing can reverse quickly when supply expands or demand slows. Customer agreements may improve visibility, but undisclosed concentration and contract economics remain important. HBF could take years to qualify and scale, while Sandisk's manufacturing relationship with Kioxia creates strategic dependency. Trade policy, Chinese competition, technology transitions, currency movements, and extreme share price volatility can also affect results. Investors should test the thesis against these risks, rather than extrapolate fiscal 2026 indefinitely. Sandisk earns strong scores for financial momentum and meaningful AI exposure. Demand visibility also improved because of the customer agreements. However, the company scores lower on resilience because NAND remains cyclical and the historical record includes 2 recent loss years. Valuation support also appears limited unless high margins prove durable. The combined scorecard describes a high-growth, high-uncertainty stock, rather than a simple directional conclusion. Sandisk already has material exposure to AI data center storage, reported cash generation, and better volume visibility than earlier NAND cycles. HBF and higher density QLC could expand the opportunity further. However, several quarters must confirm that customer agreements stabilize economics and that current margins are not merely a cyclical peak. The most useful approach is to treat the 2030 framework as a measurable roadmap, with milestones for contracts, product qualification, margins, and cash flow, not as a guaranteed destination. Thanks for watching. Like, share, and subscribe. Then visit AIStockshub.com.